Welcome to the State of the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special guest is Russ Mould from AJ Bell.
Russ Mould, welcome to the show.
Thank you for having me. It's great fun to be here.
So you're investment director at AJ Bell. What's your backstory? How did you get there?
Right. Okay. So I've been in the financial markets now for over 30 years, which is a bit of a painful admission. So I started as a junior fund manager at Scottish Equitable, which is now part of Igon, in 1991. Joined, so that was on the buy side, then went to the sell side in 1993 as a junior equity analyst at what was then called SG Warburg, incorporating Ackroyd Mullen, Smithers Rowe and Pittman. So all the old big bang names are still there.
Remember, yeah.
There's a history lesson for you in itself. And then while working for the same firm for 12 years, went through multiple business cards as Warburg was bought by SBC, which then did a reverse takeover of UBS and snaps up Payne Webber and Dillon Reed and heaven knows what else on the way. And after doing 50 sets of Philips quarterly results, I finally decided that it was perhaps time for a change, and that's no disrespect intended to Philips Electronics. Then I took a time out, then ended up as a journalist at Shares Magazine, where I ended up being editor, and then that was acquired by AJ Bell in December 2012, which is how I ended up where I am now, and a good thing too.
And in the time you've been in the city, what would you say has changed markedly over that period?
Apart from everything. Well, I suppose Sweetings and the Georgian Vulture are still there. So I suppose those are two constants at least in terms of meeting places in the restaurant scene. I think in terms of what's changed, I think looking at it from the perspective of somebody who's really been a trained analyst for their whole career, I would say that good research is an awful lot harder to find. I find a lot of the stuff that I'm lucky to be sent now is almost sometimes indistinguishable from the PR and the results handouts that come out. So I think there's been a much greater emphasis on velocity of product rather than in-depth analysis. And when I joined Warburg, I was told by the then head of research that if the team I was working on produced 2 pieces of research a year that changed market perception of a stock and were right, we'd done our job. Nice. And I think that isn't the case now. It seems to be much more about flow generation and velocity of comment. And I think that's probably been a massive change. And, clearly, ubiquity of information. And a lot of that is for good regulatory reasons, so that it's as much of a level playing field as possible. But it also makes it harder for the analysts to provide any value added, because either you have to disclose your sources or you can't publish. And I think that's been in some ways a bit of a detriment. But equally, I guess it helps keep people safe, makes it a more level playing field. And then you've got the internet and the rise of social and everything else. In terms of, you've probably gone from having too little information to having far too much. I would think is probably the biggest change of all.
Do you think anybody actually reads research on average? I mean, my theory is. I remember when I was working at Merrill Lynch in the late 90s, Merrill Lynch at the time, I believe, was the world's biggest consumer of paper because of its research output. But my own theory is that it used to be the case that because everything was bundled together, people felt that there was an obligation to put out research that would be read. And ever since basically brokerage became, dismantled and kept separate from the research, then because it's practically free to deal now on an exchange. It's very, very low cost, and so that's thrown into sharp relief the value or lack of value of what used to be associated research.
I think it still has a value, albeit probably not the value that its hard pressed authors would like to think. I think it still does a good job of distilling what are the key issues surrounding a company or a market or an asset class. And I guess it also helps unwittingly formulate what is the consensus. So at least you know what the market's thinking right now, and you've got that as a sounding post against which to then sort of benchmark your own judgments and what you think the potential upside and downside is according to different scenarios that develops. I think that still provides a useful distillation service. But I think, do institutional managers place a whole lot of value in it? Probably not. Because a lot of them have got their own internal research houses, and for retail investors, it's very hard for them to get hold of anyway. So I think, in terms of helping you distill what's known and what the issues are, great. In terms of shaping a view, not so much.
So what sort of things do you do at AJ Bell right now?
Well, I've got 3 or 4 different hats. The great news is for somebody who's high on vocal energy is I'm largely paid to talk for a living, which is nice. So my main job is to be a sort of media representative and spokesperson, or even brand ambassador, if you wish, as part of the wider PR and marketing effort for AJ Bell. And that's an ongoing drive for the company, what remains a very competitive marketplace, but for advised clients or for retail customers. And that's a big chunk of my time is broadcasting or helping print or online media and prepping for broadcasts. I also write weekly comments for our clients and customers and do videos for them. I speak at events and conferences. And I'm also on the investment committee because AJ Bell fabricates its own funds of funds as part of AJ Bell Investments to try and make investing easier for customers and clients and trying to help cut down on the research time that they need to do. We're not regulated or authorized to give advice, so we can't do so, but we do try and help provide products that cut down on the research and that the customers and clients need to do for themselves to get the results, the outcomes that they want relative to their own particular goals.
So you'll be distilling information from the markets on a day-to-day basis and relaying that to clients. What's your go-to place for good information, and what do you look for to tell you accurately where the markets are going?
Yeah, I read the regulatory news service in the UK from top to bottom, so I read as many of the result statements as I can. So I'm going straight to the primary source there, and that's always where I start. And most of what I'm asked to do is on the RNA, is on the UK, but it's not exclusively so. And as the UK's global weighting has shrunk and there's been more interest in overseas markets, then that has changed round. So that, and then there'll be a number of websites, whether it's Market Watch, Market Screener, what used to be called Data Stream and Refinitiv, and is now I think LSEG Data Stream. So I keep my eye on those. And then if I'm looking at if I get a request in on a company or I'm doing a piece in a company, I'll read the accounts, have a look at the numbers, put all the analytical training into practice. And then there's a number of blogs that I enjoy reading. Unfortunately, I don't try to pay for too many because there are some brilliant ones out there, but we've got shareholders and I don't want to drain too much money away. And so, and also my own pocket only goes so far. So but I do try and keep in touch with some terrific blogs out there. And I will keep half an eye on X and social, because there is actually some pretty clever people out there operating. I guess the only caveat you have to work with there is, if you're reading what a smart hedgy or a smart fund manager's popping out, then they are probably talking their own book to some degree. So I guess you need to be a little bit careful. You're not allowing them to find a convenient exit or entry point for what they're looking for.
Do you use Substack?
I do, yes, definitely. And things like Doomberg, I take great pleasure in and find very informative. And Haymaker, David Hay, and the Gave brothers' work, I find that enormously informative and thought provoking.
So what's your, I'm guessing your underlying research is based on, would it be value investing? I'm kind of putting words into your mouth. I'd like to know.
You are slightly, but but when I was at Scottish Equitable, I was trained as a value investor.
Right. Okay. Because I was thinking the account stuff, but you're obviously you're using the information that you've just said, in my mind, just to keep up to date with what's going on. But your core principles of analyzing whether something's undervalued or overvalued must come from somewhere else. So what is that?
Yeah, and it comes from valuation, and that's how I was trained. And it's also how I was trained at Warburg, if the truth be told. And I guess then, then after that experience, good and indeed bitter, of, if you do look at a stock and you get it wrong, where have you generally got it wrong? And it's generally been in the balance sheet. Right. You've got to look at balance sheet for, in my opinion, I should stress. I think, it's naturally tempting to look at the P&L first and look for the earnings per share figure and kind of work backwards from there. But really, you need to start with the balance sheet, because that provides you with your downside protection and makes sure the clock isn't ticking against you. And then you look at cash flow, and then you look at P&L. And a former Warburg colleague, a smashing chap called Michael Cale, who has actually written a book on financial analysis that's I still have behind me on my bookshelf here and occasionally refer to. He talks about taking a 3D view of a company, and that's the sort of route that he takes as well. And in his kind of cheats rule of thumb is the rule of 3. Over a period of time, you would expect to see sales, operating profit, and cash flow to grow at a reasonably similar pace. And companies where it doesn't do that consistently is generally where there's probably perhaps some accountancy sleight of hand going on day one, say, or where there's potentially something going on that you need to to look further into. So there are lots of little rules of thumb like that I've used over time, which I think have hopefully helped keep me away from trouble. It does mean that you do miss out on things, but I've, as a Yorkshireman and therefore a fully paid up member of the awkward squad, I'm not actually. I actually have fairly limited FOMO anyway. I'm not that frightened of missing out, and I try and stick to my disciplines, and sometimes accept that it's not gonna. They aren't always gonna help me. And if you read Alistair Mundy's book, You Say Tomato and I Say Tomato, that was a summary of the comments he used to write for his clients when he was an investor. He said value investing can be like sitting on your own in a restaurant on Valentine's night. It can be, pretty testing at times. And there are periods when you sit and you think, I'm clearly doing something wrong here, because there's clearly quote unquote easy money to be made, and I'm not necessarily there. But the things that are happening, certainly in some markets right now and some securities right now, wouldn't fit with my personal risk parameters or style, and I just have to accept that and move on.
So accountants are very clever people, and when it comes to company accounts, there are obviously ways of kind of, dare I say, hiding things or gotchas that people might not look out for or not know to look out for. In your experience, what should people be looking for as red flags that on the surface everything looks okay, but actually when you look at X, it might not be?
Yeah, profits for show and cash flow for dough is the ultimate thing. You've really got to look at the cash flow. And I think if a company is being in any way cute or is pushing things a little bit, revenue recognition is always going to be one area that can be flexed a little bit. And that means you need to look at things like trade receivables, whereby if a company's booking revenue but haven't been paid, then the receivables will go up a lot. You need to look at their inventory, particularly with software companies, there isn't any particularly, but that will still show up in the receivables. But with a manufacturer, you can load your factory and keep on shoving the stuff out the door to keep your overhead recovery very high. But if the stuff's then piling up in a warehouse or in the car park, at some stage you're going to have to liquidate that inventory and either cut prices or slow output or both, and that will then have a very detrimental effect. Or the other good game they can play is just write off the inventory to zero and start again. But again, that probably means there's something gone wrong there. So it's very much if you're looking at a manufacturer, and Philips Electronics was actually a brilliant case in point. When things were going well, inventory was low, receivables were low, and when things started going wrong, when the top line started slowing down, inventory would bloat, receivables would bloat, and cash flow would dry up. And that would be a sign that there was trouble ahead there. Now it's a very different business, but that was always the balance sheet used to go up and down like a squeeze box or an accordion. So you could almost track that and use that to lead you into the profit cycles quite closely. And it used to be harder because leases were off balance sheet, whereas now they're on balance sheet as a matter of IFRS 16 accountancies. That actually means it's easier, but leases would often trip people up. Contingent liabilities would trip people up. And again, generally speaking, a bad company with a weak balance sheet, it may be cheap, but time is always working against you. Whereas if you have a decent balance sheet and there's no major interest payments or lease liabilities coming up, time is at least on your side to get you out of trouble. So those were always things you need to look at. Well, when that cash was due, as well, that would generally keep you on the safer side of trouble, shall we say? But the combination of also what you never really want to see is huge amounts of operational gearing, i.e., 1% change in sales leads to a much bigger percentage change in profit, coupled with financial gearing, i.e., debt and leases, because that's when things do go sour. And some of the recent accidents we've had in the UK financial markets, like say Carillion, I know management took a lot of stake. And I think in the end, had things gone well, they would have been fine. But the business was very, very stretched in terms of finally pulled. So there was little room for error. So there was a lot of debt, a lot of leases, a pension liability, and very thin operating margins, which is not a good combination. And if anything went wrong, as it eventually did, then the margins went foot, and then you were really struggling to meet those liabilities. So it's looking for not just how does it look now, but what are the pressure points and what can change. And I think operational plus financial gearing can work brilliantly when it's in your favour, but they're and work really badly against when you go wrong. So even if you want to play that kind of name, I would personally view them as stocks to rent and trade rather than stocks to own over the longer term, because they can get you into an awful lot of trouble when things go badly wrong, or even slightly wrong.
I've heard Tim mention the cash flow element.
Yep.
Tim, what would you add to that?
Nothing. I think Russ has covered all the major bases. I started by asking whether the city had changed or what had changed. Do you think investor psychology has changed in the time you've been working?
I think human nature being what it is, it hasn't changed that much in that, greed and fear still predominate. And I think that is and people say, well, there should just be more regulation. Well, you can't change how people behave, and people will get overexcited at the top of a cycle and over frightened at the bottom of a cycle. And if you can regulate your emotions and be as dispassionate as you can, and it really isn't easy, then that's when the most glaring opportunities present themselves. I think what's probably become harder from the perspective of the professional fund manager is you can argue, and I think this is a point that you make in some of your blogs, Tim, that they are in many ways asset gatherers and harvesters, and because that's how they generate their fees. And once a fund gets to a certain size, it's probably pretty difficult for it to be nimble when it needs to be, if it needs to be. And also this tyranny of measuring yourself against benchmarks and indices does tend to encourage a degree of playing safe. And I know that the Financial Conduct Authority is doing its best to root out index huggers, but I think that is also a challenge for the investor looking at funds, and the ones that may provide value in exchange for the fees that they charge, and some clearly do, is that the pressure that's built from the rise of passive investing and the rise of indexation and index tracking means that there's a spotlight shone on fund managers, and it can be every quarter, which I think is no real fair test of a fund manager's skill.
I think one thing I was thinking about was the average holding period for an investment. Yes. Because back in the 60s and 70s and dare I say 80s, people would hold on to things for months, if not years. And now the average holding period for a stock has gone down to, in some cases, minutes. Yeah,
I don't view that as particularly healthy at all. I can understand how it's happened, again, because there's more information out there. There's more temptation to press a button, and it's easier to press a button and do something. But I'm not sure I'm not sure it's a healthy trend. You can argue that platforms such as AJ Bell are facilitators of that, but when we try and provide investor education, we do try and say, well, if that's what works for you, great, but there are other ways of doing it, and just be very careful how things like fees can open fees compound just as much as dividends, and the effects can be just as detrimental as dividend compounding could be positive.
Because one thing I was struck by fairly early on in my career when I was in the bond market was, I was in sales rather than trading, but I was conscious that there were a lot of traders who sort of felt obligated to always be doing something. And clearly that can't work all the time, because there are only so many good ideas. So not that I ever had aspirations to sort of manage a dealing room, but if I was in charge of one, I'd say, look, if you haven't really got anything to do, then just go off and play golf.
Yeah, I don't think it works like that. I mean, legendarily, John Mack always used to tell people off at Morgan Stanley if he caught them reading the newspaper at the desk because he wanted them to be on the phone, he said they should have done that on the way in. So I think there is that pressure to be seen to be doing something, and I think investors sometimes do feel that pressure to do something. When, as Buffett always used to say, if you enjoy switching the screen off on Saturday and Sunday, try it Monday to Friday as well, because it might actually be pretty good for your mental health. Yeah. So I think that is the danger of, that ubiquity of information that we discussed right at the start, is it can lead you into temptation to do something that you perhaps wouldn't do otherwise, when often sitting still is the best thing to do. And, I suppose a classic recent example, it's only 4 years ago since we were still under lockdown or near as makes no difference. And, I had a lot of friends who were saying, crikey, we shouldn't we be selling now? I said, well, the market's just gone down by a fifth in a week. If anything, I'm not giving you any financial advice, but, if you think this is going to blow over, maybe you need to be thinking the other way. And I think the platforms such as AJ Bell we'd like to think provide a fantastically helpful service to people and do make investing easier. But at the same time, we certainly don't want to think we're encouraging people to overtrade by any means, because I think that is generally when you're getting into more difficult waters again. Fees tot up, and also, I forget who it was who said it may even be Buffett again. Nobody's going to get rich from their 50th best idea, are they, necessarily?
Yeah, having a filter for information is so important, and that's actually why I wanted to ask that question at the start about what you actually use yourself. It's more about what you don't look at rather than what you do. But what would you say that sounds like what you've just mentioned there as being one of the best sort of calls you may have made. But what would you reckon would be like one of the best and one of the worst calls that you've kind of made, and what did you learn from it?
I think Carillion was one that worked very well. And I was asked once on Radio 5 Live what I thought was going to happen at Debenhams, and I said it was going to go bust. And there was this gasp.
So you knew you were right, basically.
Well, yeah. Well, I said the thing is, and Debenhams wasn't down to the trading, although having my lovely lady wife working fashion at the time, and she said, "Look, this thing it's permanently on Blue Cross sale. You know, the brand's just been hollowed out by this insistence on generating like-for-like growth and relying on sale to do it." So that was one side, but also the balance sheet was just, it had no debt, but it was laden with leases, over £1 billion of leases, which for a business that was making very thin margins and was seeing its top line slowly whittled away, you know, that was one where time was going tick tock badly against it, and also, so again, and Carillion was also a balance sheet led thing. Worst calls, gosh, that's an awfully frighteningly long list. I think the one that probably gave me a huge amount of ulcers when I was as an investment analyst was covering Nokia, which started off as this Finnish welly boot and chemical and consumer television company, and actually was then a leader in mobile phone and 3G mobile technology for a long time. But it was an extremely volatile stock, and I remember constantly having candid and frank debates with the trading desk. At the time, the head of whom was Ian Waste, now of Marshall Waste Hedge Fund. And Ian's a lot richer than I am, so I'm not going to knock him in any way, shape or form. He was a smart lad and still is. You know, he was always of the opinion that mobile phones would become just colour tellies and a 3% operating margin business rather than the 20% operating margin business. And I guess you could argue we were both right, because Nokia had it off for most of a decade and then got firmly canned and superseded by Apple and Samsung. So
is Nokia even still going?
It is still going. It doesn't make. I think it's now making just network equipment only. I think, but it's in a very, very diminished form. So I guess the issue there was that you could probably say that I had the better of it in the short term. Ian definitely had the better of it in the long term, and it was at times very stressful because there would be huge swings again in working capital in the balance sheet, and then there'd be a really hot quarter and a really cold one, and that stock was very volatile because it was biggest stock in the Finnish index by miles and one of the top 10 in Europe. So again, ownership was wide, valuations did get high at various points, and that was when the risks became high. And I guess that's something that I'm always thinking about now with regard to the Mag 7 and what could be the point that makes people come to, oh, maybe these are a little bit spenny or not. And actually there might not even be one. It might just be you kind of run out of people who want to own them in sufficient size, and the thing just starts to gently slide away, which I guess we'll have to find out. But with those stocks like those, when everybody starts on one side of the boat, eventually the boat's either going to tip over or people have to go back to the other side. So, but you just don't know what the catalyst for that is going to be. But Nokia was very stressful.
It's a fantastic cautionary tale, though, isn't it? In specifically, given that, as you say, we've now got the Magnificent Seven, we've got the rise of stocks like Nvidia, which I wouldn't know where to begin to try and put a valuation on, but it does seem to be absurdly high.
Yeah, it wouldn't fit with my own personal investment parameters. I think is the way I can put it without getting in trouble with my compliance department. And I always go back to that quote from C. Scott McNeil again. So as somebody who was an equity analyst.
That's a Sun Microsystems.
As somebody who was an equity analyst during the 1990s, and I started off on a team of 4. We were covering probably 15 or 20 companies between us. And in 2000, we were a team of 60, covering God knows how many. And we actually, led by a really bright guy called Gavin White, went bearish on tech as a tech team in June 1999. And the grief we got internally was something to behold. And actually externally, because the NASDAQ doubled in the next 6 months. And okay, it then, went from what? 3,000. It went from 3,000 to 5,000 in 6 months, and then went all the way down to about 1,200. No, it went down to 666, didn't it? So it went all the way down to 666, and so we were right. But for those precious 6 to 9 months, God, did we look wrong? And our investment bankers were going hungry because we were saying we're bearish, so we weren't doing as many deals as everybody else. So the pressure there was high. The pressure from the traders and was very high, and the clients weren't happy. And in some ways, when we were kind of, you could argue, quote, proven right, unquote, we probably really didn't get desperately thanked for it. We probably almost partly got blamed, which again is one of those things about, in terms of your career, it's probably better to fail conventionally than it is unconventionally and stand up. So that's, goes back to the pressure on modern day fund managers. But I think, it is a slightly cautionary tale. And nobody wants to stand up and say now, I think Nvidia's a crunching great sell, because nobody probably expected it to do what it's done now. So, and it's, if you had gone short, you'd have got absolutely run over in the meantime.
It's so interesting how the psychology almost forces you into the common view, and especially the pressure at the absolute worst time is the strongest. And we're probably going to be heading towards a period like that very soon.
I think that's right. I mean, we were under that pressure at what was then UBS. Tony Dye was under that pressure.
Tony Dye. I was just going to mention
BDFM,
Tony Dye because it's such a famous example, such a celebrated example.
Tell us, what was it?
Yeah, go Tim.
Oh, you go, Russ.
Yeah, but I mean, he was, I think, the head of UK equities at what was then PDFM, or what had been known as Phillips and Drew Fund Management, and part of UBS, and he was just saying that he understood the tech thing was just overcooked, overwrought, and overbought, and his funds underperformed.
But he went anti a lot earlier than you guys did. Didn't he
did much earlier. Yeah. So he gone a couple of years early, I think, and he eventually retired or left the business, and I think that almost called the top to the day. And I think Stan Druckenmiller more or less admitted that he did a very, very similar thing. And I guess he then cracked and piled in right at the top.
Did he? Stan Druckenmiller?
He did years of outperformance in the space of 6 months because he just couldn't take it anymore and just felt he was clearly wrong and had to get involved because he'd clearly misjudged it. And actually, again, just as Tony Dye was leaving the business, Druckenmiller was piling in. And so again, the similar, different extremes, but the same quandary, but both bellowing. And I've actually read a few blogs over the weekend that the sort of softer signals that people look for, whether it's fountains in corporate headquarters or new flashy headquarters and all that kind of thing. And one that a few people have been flagging is Jensen Huang, the chief executive of Nvidia, at this Computex event in Taiwan, being asked to autograph the chest of female fans. I must stress they were wearing clothing at the time.
So given your own viewpoint and experience, do you think that we are potentially approaching a peak period in the markets? Not maybe similar to what we saw at that time, or perhaps similar to the global financial crisis?
We're seeing things that remind me very much of the build-up in 98, 2000. Very, very much so.
Yeah.
Yes.
So how far away do you think we are potentially?
Gosh, I didn't know in 1999, Paul. So, and then I got myself fired. So,
yeah, but this is a safe space.
Dilemma.
This is a safe space. You can say whatever you want, and we have a very open-minded listenership. So if you're talking against the mainstream, I think a lot of people who listen to our podcast really do understand that
I would be inherently uncomfortable piling into a situation whereby 7 stocks represent a third of the S&P 500, and that in turn represents about 65% of global market cap. And that there have been similar episodes before with tech in 68, 69, with the Nifty 50 in the US in 72.3, with tech in 98 to 2000. And they don't end well, but you don't know when they're going to end. But again, you just get that sense that if everybody is sitting on one side of the boat, eventually people either have to come back to the other side, or they're going to fall into the water. So evaluation is my guide. And to go back to that, C. Scott McNealy quote from Sun Microsystems that made Tim smile then, that at the time he said, well, I think with the benefit of hindsight, if the truth be told, he said, my stock was trading on 10 times sales, which means that it's going to take me 10 years to get you your money back. And that's assuming I've got no cost of sales. I pay no tax. I don't develop anything in R&D, which means my business will be dead in 10 years' time because I haven't done anything with it. What on earth were you thinking? And I think most of the stocks that we've just mentioned, certainly Nvidia at least, trades on a much bigger multiple than 10 times sales now. So again, I think you do have to proceed with caution, albeit in the knowledge, if the Federal Reserve starts cutting rates, which I suspect it's itching to do because there's a big US debt problem out there and it needs to get that $1 trillion annual interest bill down. Who knows when there's $6.5 trillion worth of money sitting in US money market funds waiting for a home right now. It could be the sort of boom that makes Tim's Japanese boom of the late 1980s look like a Vickers Tea Party, but it wouldn't again necessarily end that well.
Do you think the US debt situation can be resolved?
Can they pay it back? No. So so now it's a matter of what are your alternative solutions. So you either have to try and grow your way out of it, which maybe they, with an AI boom and electrification boom and a green, but they could certainly make a hole in it. But I think logically, inflation is the most likely way out of it, I would think, and that's not a situation exclusive to the United States of America either. I mean, if you look at, when I was, I'd never studied economics, which I've always hoped was something that would serve me in good stead, and I still feel that it probably does from a financial market point of view. But when I was first taking an interest in economics, then listening to Mrs. Margaret Thatcher and Professor Sir Alan Walters, all they talked about with regard to monetary policy was money supply and nothing else. And I was always taught, supply of something goes up, its value generally goes down. And over the last 5 years, money supply has run rampant in Europe, the US, and the UK. You could argue the pandemic was a big part of that. Whether you think that was the correct thing to do or not, I will leave to the individual involved. But money supply was rampant, and therefore you would think at some stage there has to be a cost. There is no such thing as free money. So your cost is then either higher taxes to pay the money back. Well, politically, there's no appetite for that, so forget it. Higher interest rates, well, we've got those. Higher inflation, we've had that. So I think that, from the debt perspective, you end up with a default, which I think that people will avoid by just printing more money. So it feels to me as if we've probably slightly crossed the Rubicon in terms of where we're going, and it's just a matter of when the printers restart again, because it feels to me that that's the only real way in which you can kind of find your way through, or at least you try and inflate the debt away as best you can by keeping interest rates below nominal GDP growth as best you can. And it's worked before, and it'll probably work again. It's just a painful process for people. Who
do you think is going to win the US presidential election?
Gosh, I don't know. It kind of feels to me like the orange man's got the inside track on the key swing states at the moment, so maybe he'll just edge it. And for me, he feels very inflationary in that he's not known for being careful with other people's money. He certainly was pretty good at spending it when he was last in, albeit not as good as the Biden administration. And things like tariffs, to me, feel inherently inflationary, and so does saber rattling, and war is generally inherently inflationary for the disruption of supply chains that it brings, the sequestration of assets for the war effort that it brings, and the shortages it creates.
Not that you can
besides all the other important, and wretched humanitarian angles involved.
Not that you can blame Trump for the wars that are occurring now, because he had nothing to do with either of them.
No, not at all. Intriguingly, no. And I'll be intrigued to see what he does if he gets in. And I guess that remains one of the wildcards. And equally, equity markets were terrified of him in 2016, and then the S&P had a generally pretty good time of it under him. So again, I try not to get too involved in the politics of it, because in the end, it's ultimately going to be down to earnings and cash flow that are going to really, really drive where share prices go over the medium term.
And do you have a view in relation to sort of domestic politics? I was amused to see Dominic Frisby's just got a new song out, which ends with the hashtag zero seats. 0 seats for the Conservatives, which is I
live in the constituency of Brighton Pavilion, despite the Yorkshire accent. So I've got the only Green MP in the country. So I'm a complete outlier here, and their streets ahead in the polls. And then, barring the Lib Dems, they're the only people who made any effort whatsoever canvassing around here. I think I'm led to believe for the papers that Labour are kind of focusing on seats where they need a 15-point swing or less, while they're a lot further behind that in Brighton. So I can only assume that they're not viewing this as a target seat, even if intuitively you would think it probably would be Brighton Pavilion, because Hove is Labour right now, with Peter Kyle, who's been a long-standing institution there, and Kemp Town I think might be as well. So I'll certainly put it this way: they've all had a history of being Labour. I think Brighton Pavilion was Labour when Tony Blair got in 1997, and they're all perfectly capable of changing their minds and changing allegiance when they feel it's appropriate to do so. So I'd kind of wondered whether Labour would view this as a seat to win, but I get the impression so far not so.
How much do you have to change your analysis process when you're looking at company accounts, when you're looking at UK, European or US stocks, or indeed Japanese stocks?
I think overall it's a lot. Japanese stocks I do still find quite difficult, I have to say, and I probably don't look at the Japanese market as closely as the others, even though it clearly was mind-blowingly cheap. I don't know, Tim was there banging the drum for a long time, and it's still got a lot of things going for it in terms of great cash support on balance sheets, corporates not doing anything silly, actually, if anything, becoming more shareholder friendly than they've been for a very, very, very long period of time. I mean, when I was a junior analyst at Warburg, it was comparing like for like was much more difficult than it is now. I think it's intriguing talking to my friends and former colleagues in America and brother-in-law who works for a US firm. American firms are run differently, and I mean that in the sense that they are much sharper of tooth and claw, and are much more aware of the quarterly number and its importance in the near term. And a lot of my American colleagues view Europe as a bit of a retirement home because we all take 5 weeks holiday and shut down for the summer and yada, yada, yada. And I think when there's this debate about the UK is cheaper than America, is that right? Well, I think that is one of the reasons why. Whether the discount is as big as it should be right now, I think is possibly a different question. But certainly to expect the UK to trade on a US style multiple when US firms, I think generally like for like do make high returns on capital, high returns on equity, high margins, and are just more ruthless, I think it's hard to justify. But then it's a matter of what you feel comfortable with as a person, as a society, I suppose.
Is that just because they're more ruthless, or is it because they're just better at other things then?
I think there's the UK has obviously got a very strong equity mercantilist culture, but I think in America it's reached a new level, and I think there is much more interest in the stock, and I think there's a much more awareness of people just among their ordinary savers about their 401ks, and I think there is just an acceptance that you work for a firm that you got to get your head down and you bottom up, and if you don't, then there could be consequences.
And when you're valuing a company or a sector and you have a certain view about what the fundamentals are telling you from your research, and then you have an event like, say, Trump getting in, which is usually highly positive for the markets from a market perspective, how much does that influence your view sort of short term to long term? Do you make an allowance for that and its positive boost to certain shares, or do you just stick with, right, the market's still overvalued if it indeed is, and then just let it play out?
I think I'd probably stick to my principles, my disciplines, and just say, okay, well, that's just the way it's going to be. I mean, when we're at the investment bank, we ran, the guy who ran the tech team, Gavin, in the end devised a model which was kind of a backwards way around discounted cash flow. So you effectively worked out what was the trend growth rate of profits and cash flow that the market was discounting, and then you took a view on whether you felt that was sensible or not. But that still did involve some very sensitive inputs, one of which was the discount rate that you used, and the other one which was the equity risk premium that we'd used. So I guess in the case of Trump, you would say, oh, well, we think that he actually might be positive, so therefore we'll lower our discount rate, we'll lower our equity risk premium, and therefore that means we can comfortably discount a higher growth rate than we would have done previously. So it was quite mechanistic, but there was still an element of subjectivity into it. I don't run anything quite as broad ranging as that now because I just haven't got the time. But I guess that's what would be in the back of your mind. But equally, a presidency lasts for 4 years. So again, going back to Tim's point about time horizons, somebody who really does try and take a very patient view of things. 4 years, is it that long a time? Not really, but you certainly have to accept the fact that there will be ebb and flow within that period for sure.
Have you used any modern AI tools to help you with your analysis? Has it helped you in any way, or do you think that there's too much emphasis on that at the moment?
I don't personally. I know that my employer is working on it a lot, and I guess I'm just waiting to see from I'm following very closely those Mag 7, what their spending plans are here there in terms of either the investment they're putting in or the products and services they're expecting to develop, and therefore the returns they're expecting to get. And at the moment, I'm finding it quite hard to get a really strong sense for them when they think they're going to get a return on the investments that they're making, which I find quite intriguing. I think Satya Nadella talks about being able to compose emails more easily, which I found a bit disappointing. So I'm sure it's early days, but I think that's something that we'll all need to keep on watching very, very closely.
In my experience, I've tended to find that some people have this feeling that they're being wronged by the professionals in some way, and there's like this Holy Grail that they're not party to, and that's why they're not they're making money. And when they have a different attitude towards when they make an investment, so they don't understand as much the element of risk that you're dealing with and probability, and the fact that you might be saying, look, this could go up, but nobody knows anything, it might go down as well. You're taking a balanced risk. So they expect you as a professional to be right every single time and tell them exactly what to do. What sort of mistakes, or what would you say the biggest mistakes that these types of investors make, and how can they learn from them?
Yeah, I mean, AJ Bell is, it's a platform for both direct to consumer and advised clients, and we've now got more more retail individuals than we have advised clients. Although the advised clients on average have the bigger pot, and that's all a matter of public record from our our interim results that were published a few weeks ago. So I'm still very much in that milieu now. And when we do investor events, again, we don't provide advice because we're not allowed to, but we do try and provide education. And the one thing that I constantly do try and preach, well, preach is not the right word because that sounds a bit boring, but try and emphasize is the importance of valuation, the importance of balance sheet, and the importance of understanding risk versus reward. And one of my more difficult jobs for AJ Bell is writing a weekly column for the Telegraph, that's on Daily Telegraph newspaper, that's on specific stocks. And it's difficult because I haven't got as much time to see companies and beat the tires and go through the accounts back to front as I would like, because I've got so many things to do. And some weeks, writing a national newspaper column of 800 words, you just like to say, actually move on. There's nothing to do here this week, but you can't do that. You've got 800 words to write. And again, that can lead you into trouble and doing things that, you wouldn't normally do. And so that in itself has been very instructive. I think if, when we first started off, I kind of built a portfolio of 25 or 30 companies. If I'd left it, I'm sure I haven't backtested it thoroughly, but I'm convinced it would have been a heck of a lot better if I just left them alone for 7 years than if I toddled around with it every month or so, tickled around with it every month or so. So that in itself has been a lesson. But I think one of the difficulties as a retail investor, I think there is that nagging fear that they don't have all the information available to them that the professionals do, which I think, from a regulatory perspective, I think is not. I'd like to think is not correct now. There is more information available.
I'd also make the case that a lot of professional, and you've alluded to this already, but a lot of professional habits are actively harmful, namely indexation. So if you don't have to play by the same rules, you might as well exploit the ones that you don't have to follow.
Yeah, I think it's a good one.
For people who don't know what indexation is, could you explain that?
Sure. So, for example, if you're say a UK equity manager, then there's a good possibility that your equity fund, if it's domestic, will be benchmarked against maybe the FTSE 100 index, the 100 leading stocks, or the FTSE 250, or maybe the FTSE All Share, and that effectively means that you have to pretty much replicate the index within your own portfolio. So what Russ referred to earlier as index hugging. But if you're a private investor, you don't have to be benchmarked against anything. And secondly, if you do have a benchmark, it can be entirely one of your own choosing. So in our own business, for example, we benchmark effectively, implicitly against cash plus or inflation plus, but we couldn't give a stuff about the index because we don't have to follow the index.
Yeah,
Sorry, just to finish the point. The problem with indexation is that it is almost an abnegation of conviction because you're not really expressing a view about anything. In other words, I remember you spoke about Nokia earlier, and I'm sure there was a time, if it wasn't Nokia, it would have been Vodafone. That Vodafone was, I think, at one point something like 15% of the market, but funds were limited to having 10% holdings in any one stock. So you couldn't get enough Vodafone in your portfolio if you were an index tracker. So you had to go to all kinds of, play all kinds of whizzy games with derivatives just to get to your index weight. Well, that's nonsense if you don't like the stock in the first place.
Yeah, and frankly, not owning a Vodafone has been a good thing for the last 10 or 15 years anyway. So that's been an absolute nightmare. I mean, so the thing that we try and say to retail clients is, first of all, you need to ask yourself 4 questions before you set off on any investment decision or any journey. Is why am I doing it? Which is basically how much have I got now and how much do I want when I finish? What's my time horizon? That then drives your target return over time. And then how much risk are you prepared to take in quest of those returns? And risk being defined by the old Buffett thing of willingness and ability to suffer losses in search of a return. And once you answer those questions to yourself honestly, they will shape to a degree which asset classes you feel comfortable with, which instruments you feel comfortable with, whether it's direct or collective, or heaven forbid derivative, which hopefully a path that people don't tend to go down. And then your target return will give you a feel for which asset classes you're interested in, whether it's equities or commodities or property or bonds, so answering those 4 big questions first will cut out a lot of research, give you a feel for what you need to do, how much risk you're going to be embracing in terms of your target returns, and that will hopefully save you a lot of heartache as well as a lot of research. And then after that, if you are looking at specific stocks, which I think we've made clear isn't easy and is perfectly capable of tripping up even the most hardened and well-informed and well-trained professional, then you go back to Charlie Munger's 4 tests. Do I understand the business? If the answer is no, then just walk away. Does the business have intrinsic value? So does it have pricing power, which it turns into cash consistently? The management operate with integrity? Are their interests aligned with yours? And then does it come at a reasonable price? And again, those are pretty good tests that are pretty hard to, and most companies don't pass those tests. So just walk away. You're not an index looker. There's no obligation to even look at them. You can just ignore them. It requires fortitude if that share price then doubles or trebles. But if it doesn't fit with your parameters, it'll probably get you in trouble at the wrong time, because you'll crack and get involved at the wrong time. So it is about being true and true to yourself and having a process and having a discipline and sticking with it. And it might mean you miss out, but hopefully it will mean that you have a lot fewer sleepless nights, because the really sleepless nights come when things that you do own are going down a lot. Having a sleepless night because you don't own something that's gone up a lot is a bit irritating, but it's not. It's a first world problem compared to owning something that's gone down a lot because you've overreached beyond your normal parameters and made a mistake.
But there are some safety mechanisms, and one of them is simply make sure you've got your position size right. So never put too much into a stock if you can't afford to lose that money.
No, and I think that something that it can happen to professional as well as private investors is falling in love with a stock, which you must never do, because you can love your football team. It doesn't make them play any better on a Saturday. And, they certainly don't love you back either. So, and I think you've got to be as passionless and dispassionate about these things as you can. And, I actually had an interesting question come in the other day about target prices. And I said, well, we're not allowed to set any because we're not allowed to give any advice. But I always have one in mind, because that's where I feel, all right, things may change, but where then the risk reward balance, I've got less downside protection than I did and less upside than I did. And therefore I need to start thinking about maybe heading for the exit if I've got it, one of those rare occasions where I've got it right and the thing's gone up. And also one of the simplest things I do is I just keep a checklist of 5. When I was a fund manager or indeed an equity analyst, I kept a checklist of 5 reasons why I was bullish or bearish on something. And if I ticked all 4 off, ticked 4 of them off, I had to ask myself this serious question: is this now all in the price? Do I need to start thinking about going the other way? Because I can keep on harping on about how this is wrong and this is wrong, but if the valuation is now sufficiently low and something changes, then it could start to turn around. So I think having a sense of a price target and having a sense of why am I bullish or bearish and having a checklist, Atul Gawande style, is a pretty helpful discipline.
When you talked about the Charlie Munger's rules, on the first one you say if you don't understand the business, walk away.
Well, or you can do your research, try and help you understand it.
Well, yes, that's exactly what I wanted to ask. I remember in the early days of tech, especially with Apple, I don't think Warren Buffett, it might have been Apple, but anyway, I remember Warren Buffett saying he didn't understand tech and would never invest in it, and then all of a sudden changed his view.
Yeah.
So he learned about it and then realized it was a good business. How do you know whether to walk away or whether you should be trying to understand it?
I think there's probably some industries that are easier to understand than others. I think Apple, what probably surprised Buffett and everybody else was that ecosystem of apps, which has just turned into an absolute cash machine for it. And I think Apple now isn't growing. And the law of large numbers is now working against that company. And that is going to be a challenge for it going forward on the rating that it's on, but it is still a phenomenal cash machine. And I think was it Nelson Peltz who first chewed the leg about buying back stock and paying dividends 10 or 11 or 12 years ago? And I think at the time, the market cap was about $500 billion. Well, they've returned $800 billion in cash since then. So I think that's probably what caught Buffett's eye. And in the end, it's the hard numbers and the sustainability of those that will make anybody reassess potentially.
Yeah, but I meant from an individual point of view, if you're looking at a business and you don't really understand it, do you think you should walk away, or do you think you should at least attempt to understand it, and then I think if you still don't, walk away, I guess?
Yeah, no, I always will attempt to keep abreast of my ignorance and try and work it out. I mean, that's one of the things that, again, not having the time to speak to companies as I would like, it was Peter Lynch at Fidelity always said that, if a CEO can't explain to you what the business does with a piece of paper and a crayon, then you definitely don't want to be getting involved. And I think that is probably still a good test to this day. You do read a lot of corporate statements that are just word salad.
You mentioned about staying out of things that might be going up and having the fortitude to do that. I can give you a sort of real world example of an expression that you may want to use. You're happy if you want to take this from me, but I was on a flight coming in to a city in Poland, and the plane couldn't land, and it was just about to come in, and it was quite a frightening experience because we were just about to, and then suddenly flew off again. The guy sitting next to me happened to be coming into Poland to learn to be a pilot, so he was training. He was saying the reason why he was coming into to Poland because it's a lot cheaper to learn there than it is in the UK. And then, so we got into this conversation about flying, and he said, we have an expression, it's much better to be down there wanting to be up here than to be up here wanting to be down there, which I thought was absolutely brilliant and applies a lot to the financial markets.
Yeah, and I think, if you're looking for another sort of, it's a bit crude, but it's a bit of a blanket test. And again, it's generally kept me out of more trouble than it's got me into. When I can see companies, and I certainly do read corporate statements and try and watch webcasts and webinars if I get the chance. And any company that says our mission is to create shareholder value, I lose a lot of interest very, very quickly. Because the next question is, well, surely what you should be talking about is how you do it. Because a business without customers isn't going to create anything. So what I'm actually interested in is how a business attracts customers. So what's its competitive position? How does it get customers to pay for what the price it wants to charge rather than the price they want to pay? Saying I'm going to create shareholder value, well, how are you going to do that? You need to have a business and a competitive proposition. And I think that, I did have a lot of company meetings at Shares Magazine where I said, well, that's fine, but how are you going to do it? And there was a bit of what do your customers look to you for? And there was a little bit of scratching about. And
really? You think such a basic question? That's incredible.
Yeah, and it was, well, we're going to create shareholder value. Yeah, but how? How do you do that if you haven't invested? What's your position? What's your proposition? And then there would be a bit of a thing. And actually, that should just be the first thing that you're talking about. How are you building it? How are you defending it? How are you improving it? And I think that is, to me, was an eye opener then. And you still see lots of statements. Our mission is to create shareholder value without actually telling you why. And maybe they just take it for granted, but it always strikes me as being something of a bit of a warning sign.
It's a bit like saying they just want to make money. I mean, it's like, okay.
Yeah, basically. Which if you've got loads of stock options, I can understand. But, so you can argue there is a vested interest there, but whether they're going about it the right way or not, I don't know. And, companies that say we want to grow the business, well, I'm not being funny. Anybody can grow a business. You can just go out and acquire. And that's not generally always an easy thing to do either, as Sir Fred Goodwin found out. So again, growth is not a strategy. It's what results from strategy, and what results from competitive position. And again, I always shy away from the transformational acquisition because it's generally management speak for we really, really wanted it and we really, really had to have it. So we've really, really paid for it. And again, acquisitions work well when they supplement existing organic momentum in the business. And companies like Halma have proved that consistently over time. Transformational acquisitions designed to create growth, they're trickier. And any acquisition whereby you're encountering two new things at once, new vertical and new geography, that's generally, again, a sign of trouble. One new thing at once you can handle, but certainly two new things at once, not so much.
Any favorite sectors, markets, geographies?
Well, when I've just been doing some client roadshows recently, and I sort of try and, again, without giving anything that could be misconstrued as advice, I always structure it on the lines of Sir John Templeton's quote about, bull markets being born on skepticism, growing on pessimism, maturing on optimism, and dying on euphoria. So I put a little grid up of, based on valuations that I can see and questions that I get and the flow of information, I'm saying, where is there pessimism and skepticism, which are the bits I'm more interested in, than the bits where there's optimism and euphoria, which I'm less interested in. And there's still certainly a lot of skepticism towards the UK. There's a lot of skepticism towards commodities and energy, which I think is interesting, given that, as far as I can tell, we still need quite a lot of them. Japan still isn't getting a huge amount of love. I guess the currency is the tricky question there, but it still feels it's got that valuation on its side. So and then really far out things like real estate and some of the more interest rate sensitive areas like house builders, to me, feel interesting just house builders a bit less now because they've had a run, but real estate, people have kind of given up on it. But there isn't going to be any more land, and I think there is a sense that hybrid working and working from home, there's a bit more of a pushback there, or people feel a bit less comfortable with it, and they'll probably feel an awful lot less comfortable with it if unemployment starts going up, because they might just feel they want to show their face in the office a bit more just to play safe. So those kind of stocks are completely unloved, trade at big discounts to book value. If you look at 92.34 when UK rates did come down, they went on like a rocket for about 2 years and admittedly then did nothing for a very long period of time. But if you catch that sort of thing right, it can be very, very helpful. And there are some out there with some decent balance sheets and have adapted their portfolios quite substantially. So that's one area that I'm doing a lot of work on, just because it doesn't feel to me like anybody else's. And you've actually seen some M&A activity recently as well, which is quite interesting.
When it comes to the element of investment areas and competition for shares, one of the big things that people today are investing in are cryptocurrencies. Do you have any views on it at all? Because I think in some ways they can drive unrealistic expectations of returns in equities or keep people out of safe equities, because the sort of percentages you're looking at in a day is what some shares will make in a year.
Yeah, I mean, because of the FCA, I still don't think as formally regulated or approved a cryptocurrency. So we don't, as a firm, get involved there for regulatory reasons.
Yeah.
So from a personal perspective, I've slightly filed them in the don't understand category. I understand the logic behind Bitcoin. Supply is capped at 21 million units. Any fool can run a printing press and create money out of thin air. Therefore, there is a store of value here, and I have some sympathy with that logic. I think it's slightly undermined by how the number of cryptocurrencies have proliferated. And if I go to coinmarketcap.com and have a look at how many cryptos there are, it slightly makes my toes curl. So I think that slightly undermines that thesis. But I can understand it, but I don't personally feel I wouldn't personally feel comfortable with it myself. And although we've got some bright young kids in the firm who call it digital gold, and I can see why, I'm not personally. Even if I was allowed to, which I'm not, I guess my firm doesn't want me talking about things in broadcast that I may be invested in myself, which could lead to all sorts of accusations of front running and other terrible things that we simply wouldn't want to be associated with or do anyway. But even if I could, I probably wouldn't, if the truth be told. Right.
Because there are lots of companies that are clearly, in the same way as when you see a statement saying, we're here to create shareholder value. There are companies that are, or coins that are created just simply with not very much when you look into it. But also someone with your skill, would you, if you were allowed to, and if you had the remit to and the inclination to, you might be able to correctly weed out some of the better opportunities, because it is a bit like value investing at this stage, because nobody really knows very much about these companies, and it takes that sort of very critical eye to work out whether somebody's got a business or not. And absolutely, and those are going to be the interesting ones in the future that will do very well. In the short term, when everybody's just excited about the whole sector and they just sort of pile money into things like Dogecoin and meme coins that don't make anything at all, it just shows you how much froth there is there. But it feels very much like the early days of the .com, where everything was going up in a crazy way, but there were a few real businesses that once the dust settled, you could work out that they were at least trying to do the right thing.
And I think the same probably applies to AI as well, in that there will be big winners, there will be big losers. Maybe some of the ones that are seen as big winners right now might not be going forwards. And I think it's a very good parallel or analogy with where we are now. Yes, I have a lot of sympathy with that view, and crypto, I just haven't had the time or the wherewithal or the inclination to look at it that closely. But AI, I think there will be a similar route out, and I think reading some of the blogs that I referenced earlier, there are some very smart people out there who are looking at what's going to drive the energy and what infrastructure is required for crypto and for AI in terms of servers and data centers and the energy requirements, and that is leading some, one could perhaps argue, willfully contrarian thinkers to think that maybe again the providers of the picks and shovels and the infrastructure and the energy might be better long-term options than some of the more obvious or more perceived to be more obvious AI winners at the moment. So that's something, again, I'm doing some thinking about and work on at the moment.
The column that you write for the newspaper, are you allowed to talk a bit about what you actually put in there? Because I'm quite intrigued as to whether you have like a portfolio of.
Yeah, there's about 40 names in it at the moment.
Okay,
so
interesting.
I try and keep it. The remit is UK equity, so it's so that's what it is. And at the moment, it is quite heavily weighted towards financials and real estate and one or two and house builders and well, again. I do try and say very clearly this might be one for income seekers when they do the research. This one definitely isn't for widows and orphans, and I do try and make it clear that it may appeal to a certain type of investor rather than there is no one answer that fits all, which goes back to one of your broader points. But in terms of some of the changes that have been made in the last year have been leaning more towards interest rate sensitives, albeit slightly heart in mouth, because never bet upon stewards' inquiries, for the stewards know not what they do, and that certainly applies to the Bank of England. But it does feel as if rates have peaked, and my guess is, if I had to guess, once they start cutting rates, they'll probably do it more slowly than people think, but then end up doing it more quickly than they would have expected. Just as the reverse applied on the way up, they were slow to raise and then got on with it really quite quickly. So in terms of the sort of newer positions, that's probably been more where they've been, because that's where the value has been. Stocks trading at a discount to book value, with the added bonus of being interest rate sensitives, if as and when the Bank of England get round to it.
Can you name the newspaper so we can find it? Or?
It's the Daily Telegraph and the Quest column every Tuesday.
Okay, great. No, that's really good. Are there any times when, or have there been any times, I should say, when you've been completely out of the market, you don't want to invest in anything at all? Or is there always something that has been unloved, even when things are overvalued, that would grab your attention?
Not that smart to time the markets and coming all out, all in. And I think there's always something to do. And I think one of the charts I look at right now to try and give me a feel for macro is I run the CRB commodities index against the FTSE All World. And, for the 2010s, equities obviously ran riot and massively outperformed commodities, but this decade commodities have gently outperformed. Although that has eased off a bit in the last 9 months because of the Mag 7 going bananas again. For the last 10, 15 years, we've had a low rate, low growth, low inflation world, which has been perfectly suited, therefore, to long duration assets and paper promises like bonds. If we are moving into a higher rate, higher nominal growth, higher inflation world, that might not be the place to be. And if we are moving into that new environment, if history is any guide, and I admit it isn't, then it isn't a reliable one, then maybe we need to be in somewhere different, which areas where there isn't been a lot of capacity added for the last time, and where we still need the stuff like commodities. So that's the way I'm kind of testing that. And commodities have been, in certain areas, I know there have been some specific situations like cocoa or orange juice, but equally there have been some more fundamental ones like copper, where there has been some strength there. And
definitely,
if we really do see a change in macro environment, and central banks do play fast and loose with inflation because of the debt situation, commodities might be one way around that one. And so I'm watching that relationship between those two indices as a way of gauging which way the wind's blowing.
It really feels like something that Tim's been banging the drum on is coming to fruition. It really feels like there's almost no other way that there's around it, especially if they're about to lower interest rates. It feels like the markets are just getting ready for a big boom. We've seen copper hit new highs. We've seen all the other base metals moving. We've seen gold. It's hit new highs and then it's hovering near its high. Silver was doing nothing, then boom, it suddenly went up. It's actually I'm a technical analyst, but it's really interesting to see from my perspective how the valuations are driving everything underneath it, and how, as a contrary sort of opinion, someone who uses that a lot, I like things that nobody else likes, and I get worried when lots of people are talking about the same thing.
I like things that nobody else likes when they're going up. Financial markets are all about getting people to agree with you later, and I think at the moment, possibly with commodities, there is potential for that scenario to develop. So we'll see, unless we go back to low growth, low rate, low inflation sludge, which it's just too trite and too simple an outcome for a remarkable period of monetary and fiscal stimulus. It just doesn't feel as if things can be that easily controlled to me, but I could be wrong.
And you mentioned the word chart. I mean, I don't know if you know, but I'm a technical analyst. Are you pro, anti, or indifferent?
I'm indifferent, if the truth be told. Sorry about that, but I do keep an eye on them.
No need to apologize.
Because markets cannot clearly always be right, but their views must always be respected. And then a perfect distillation of that view is what the share price chart is, or the asset, or the securities chart is telling me. So I do, in that respect, I will always look at a chart before I write about something, just to see what the market's telling me right now. Yes.
Yeah, absolutely. Well, but people, no one needs to apologize for the way that they look at the markets. And it's, as someone who's been doing this for a very long time, my view on it isn't contingent on somebody saying that they like it or not. It's just interesting. There's lots of different methods, lots of different ways to approach the markets. Everybody finds their own way. And if I love the idea of value, but it kind of, for me, I find it interesting. But then when it comes to actually doing the analysis, I don't think it's within my makeup to want to read balance sheets and do all the sort of digging that you do, although I find it absolutely fascinating. I look at charts, but I look at charts knowing that they're based on probability. And when I see something repeat, you expect it to repeat again, and then you can put lots of different things together, like sentiment, to come up with a high conviction view.
Yeah.
And that's how I use it. And I also think the markets are very contrary in the sense that they're always right at the current price, but they're always wrong because they're going somewhere.
Yeah, and they will do the maximum they can do to hurt you as well.
Exactly. Exactly. So to make you think that you're wrong. Was there anything that you wanted to cover that we haven't spoken about?
Answering those 4 questions about why am I doing it, what are my target returns, what's my time horizon, what's my appetite for risk, I think will save you a lot of heartache over time. And you may initially start off with a process that doesn't quite work as well as you would hope, but I still think it will, in the end, keep you out of more trouble than it gets you into. Yes. And I think actually, intriguingly, Tim saying that his benchmark is cash plus or inflation plus. I think from a retail investor point of view, that's probably a pretty good place to start, is preserving the purchasing power of the money in your pocket.
Yeah, that also means, I guess, Tim, and I don't want to put words into your mouth, but you're not going to be drawn into the latest and the greatest thing just because it's doing well. It's a very interesting mechanism for not jumping into something that could be just ready to turn.
Yeah, no, I'd completely echo what Russ said earlier about, you have to know what you're doing. If you don't understand something, then you just don't have anything to do with it. I mean, the momentum thing is different because, of course, we use trend followers to get that, independent of ourselves. So if there's something happening somewhere, then the trend followers would be on it, even if we're not.
Yes, and in sort of high, volatile, massive, corrective phases where bond markets might be going up and you might see a big collapse in, basically the only thing that goes up is volatility, that sort of period, a big crash. You need something as a counterweight. And that's why I was interested in the when do you jump out question. Do you ever come out completely? But I think in the run up to that, if from what Russ is saying, you can see when we're at the start of that phase, and then when we're in the thick of it, it becomes very clear that things become dangerous. And again, I'm not trying to put words into your mouth, but if you can see the start of it from here, then I'm sure you'll be able to spot when things are getting overheated and when it's time to stand aside.
Yeah, I think, and again, there isn't necessarily wealth destruction. There can be enormous wealth transfer if you're appropriately positioned. And I think one thing that it may stick in the throat of retail investors, but hedge funds view this as a competition. There are no friends out there, and they view this as a competitive event whereby it's about who can get the best returns. Whereas retail investors may view it as a bit more of a collegiate thing where they're all chatting and working together. But ultimately, if you buy something off somebody, you're potentially taking a profit off them. And I know it's a little bit red of tooth and claw, but retail investors don't always see it that way. But I think one thing I do try and get across to them is, if you're being so smart enough to buy something, you need to have a very good reason in your own mind why the other person is being dumb enough to sell it to you, because you are effectively planning on taking a profit out of their pocket. So you need to have really good reasons why you're placing a trade, not just you fancy it and having a bit of a dash at things, but again, have that very clear 5 reason list why you're buying it, because you must think something or have a sense for something that somebody else doesn't know. And thinking about how many smart participants there are out there poring over this stuff, you better have thought it through properly.
Brilliant. That's a great way to end the pod, I think. But we should go to media picks before we finish, right, Tim?
Yeah, let's go for it. Do you want us to kick off, Ross?
Media picks right now. I'm reading a book called Richie Benaud's Blue Suede Shoes, which is about Australia's tour of England in 1961. As a bit of a cricket fan and an amateur cricket coach, I'm actually helping coach an under-15 boys team later on this evening. So that's what I'm reading at the moment. I actually don't get much time for TV. I tend to read a hardback book at home and a softback book on the train. So the softback book on the train, I'm actually reading Heat 2 by Michael Mann, just for something to kind of give me something a little bit gentler to read when I'm playing sardines on the Brighton to London line.
It's good to have something to switch off from the markets from, definitely. Tim?
I've just finished reading something that's actually a recommendation by one of our listeners, which is Dixie. It's a book called The Return of the Gods by Jonathan Cahn. And for the religiously inclined, the sort of the spoiler alert version is that for decades they have tried. Won't exactly distinguish who they are, but they have been trying to demolish faith in the Judeo-Christian God. And those people have abandoned. This is the thesis of the book. The people who have abandoned that have in many cases re-engaged with three ancient gods, namely Baal, Moloch, and Ishtar. And it's a fascinating thesis. And obviously readers can make up their own view, but it's a very challenging concept that one specific religion has been replaced in many people's heads by a variety of basically evil Babylonian type religions instead. Pause for thought.
Interesting.
Gosh.
That's Return of the Gods by Jonathan Cahn.
I'm going to have to apologize because I haven't watched or seen anything since the last pod. And I haven't read anything, which is...
I challenge that thesis, Paul, because I think you've seen a film called Island Claws, which is a very bad horror film.
Yes, that's true. Thank you for pulling me up on that. That's great. Yes, I'd have to put that in. Yeah, I did watch that. I completely forgotten. Yes, that was a great, and it was like a classic Tim movie. So the reason why I hadn't recommended that is because I know that is something that you and I would enjoy. I'm not necessarily sure that other people would for the same reason, but it was a great film.
Minority interest film called Island Claws.
I will put a link to it.
Giant mutated killer crabs.
I found it funny. It's just great. But obviously I don't expect everyone to enjoy it. So that's possibly why I would keep that to one side. But I'll put a link to it anyway. But I am actually interested, and something that I've been talking a lot about recently, and I'm not going to put it as a media pick, but I'm intrigued as to whether Russ has ever read any of David Dreman's books.
I haven't read them, but I will be looking for them now.
Yeah, so it's Contrary Investment Strategies. There's a few books that he's written with very similar titles, and it got a bit confusing as to which was the latest one. So it's The Psychological Edge is the latest one, and that's from 2012. Maybe I will put a link to it. So just remind us where people can find you on the socials, Russ, and your website, so people want to talk to you.
I'm on X. I'm Russ Mould 1. I'm on LinkedIn. It would be lovely to hear from people rather than photocopy salesmen or executive recruitment agencies. So that would be great. Or people trying to sell me conference tickets. That would be lovely. And then the AJ Bell website is ajbell.co.uk, and my weekly blogs and articles and videos are all on there for people to come and find.
Fantastic. Well, we'll put links on the show notes for everybody to find. And it's been fantastic. Thank you so much.
It's been great. I've enjoyed it very much. Been lovely to talk to you.
Absolutely brilliant. Thank you.
Cheers, Russ.
Not at all, guys. Stay in touch. Speak soon.
Bye.
Thank you.
Good luck. Bye-bye.
And you. Bye. Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.